Welcome to the Deep Dive. If you're trying to make sense of global logistics right now, maybe understand what real resilience looks like when trade gets choppy, you're in the right place.
Absolutely. Today we are really ripping into the Q1 fiscal year 2026 earnings call from FedEx.
Right. This one dropped after hours on September 18th.
Yeah.
And for anyone watching bellwethers, companies that show us which way the economic winds are blowing.
Yeah, especially in moving goods.
This call was, well, pretty critical.
It really was. I mean, the stakes felt incredibly high. Remember, FedEx had paused guidance before because things were so uncertain. And this global trade volatility has just been a persistent nightmare, frankly. So our job today, cut through that complexity.
Find the signal and the noise.
Exactly. In this, very complicated logistics environment, we really need to know if their internal changes, their transformation programs, are they actually strong enough to overcome some really big external headwinds they quantified?
Okay, let's jump right in then. Headline results. The market seemed relieved, like the positive reaction suggests this beat eased some serious fears.
Yeah, it was a clean beat, both top and bottom line, which honestly in this environment says a lot about execution.
So the numbers.
Okay, non-GAAP adjusted EPS came in at $3.83.
Which was well above consensus, right?
Yeah, significantly. Consensus was looking for $3.59, so, a solid 24-cent beat there.
Nice upside. And then
the revenue also beat. $22.24 billion against a $21.66 billion consensus.
Okay, so that's what, about 3.1% growth year over year?
That's right. And importantly, the adjusted operating margin landed around 9.1%.
Which, like you said, in a tough quarter suggests they're managing costs better.
That 9.1% margin is definitely the first clue that these cost discipline things, they're starting to actually work. But as we kind of pivot to what drove the beat, you see this real split. On one hand, the U.S. domestic network, really strong, resilient. It's clearly carrying the load for the whole company. But on the other hand, the international side, still grappling with some serious structural weakness.
All right, so let's focus on the U.S. story first. That's where the good news is.
Yeah, the momentum is definitely domestic. U.S. domestic package services, that's what drove the overall revenue growth for the company.
And volumes were up.
Volumes were healthy. Average daily volume, ADV, up 4% year over year. And they got a bit more per package, too. Revenue per piece up 2%.
That combo, volume and yield, that's the sweet spot for profit.
Exactly. And what's really interesting is the operating leverage they showed in FEC, that's Federal Express, their main air and ground express unit.
Okay, how so?
Well, FEC revenue only grew 4% year over year. Not bad, but listen to this. Adjusted operating income jumped 17%.
Wow. Okay. So income grew much faster than revenue.
Precisely. And that pushed their adjusted operating margin up by 70 basis points. That's like the textbook definition of efficiency gains. They're saying it's the early benefits of that Network 2.0 transformation finally showing up in the numbers.
And they pointed to specific customer wins too, to back this up.
They did. Naming Best Buy as their primary national parcel carrier, that's a big deal. High volume. And maybe even more importantly, they flagged strong growth in U.S. domestic small business revenue, up over 10% year over year.
That's key, right? Focusing on those higher margin business customers, SMBs, B2B, it helps shield them a bit if consumer spending slows down.
Totally. It provides some insulation.
Yeah.
But then you flip the coin.
Right, the other side, the global picture.
Yeah, it's much darker there. International export volumes actually declined by 3%.
Oof. So global air freight's still soft.
Still soft, yeah. And then there's FedEx Freight. That's their LTL business, less than truckload. The big pallet shipments.
Right, not filling a whole truck.
Exactly. That part of the business is still under pressure. Why? Because the industrial economy, the part that uses LTL heavily, it's been sluggish for a while now. Prolonged weakness.
Okay, so weakness in LTL, softness internationally. That's sort of expected, maybe. But there was one specific risk factor they really hammered on, wasn't there? Something about tariffs.
Yes. This really dominated the discussion, and it needs unpacking. The impact of U.S. tariff rule changes, specifically the removal of the de minimis exemption.
Explain de minimis quickly for us.
Sure. So basically, this rule used to let certain low-value imported goods, think small e-commerce packages, come into the U.S. duty-free. and with minimal customs hassle.
Okay.
Removing that exemption, it fundamentally changes the game for cross-border e-commerce and anyone shipping those kinds of goods. It adds cost and complexity.
And FedEx put a number on that impact, a really big number.
They did. And this is honestly the biggest takeaway from the entire call. Just in Q1, the headwind to adjusted operating income was $150 million.
Just from that one change in one quarter.
Yeah. But the really big one, the one everyone needs to focus on, is the annualized impact for fiscal 26. They projected a massive structural drag of $1 billion to operating income.
$1 billion.
Yeah.
Just from that tariff change. Wow.
It's huge. And it's not just, lost package revenue. It's operational friction. It's added cost.
Okay. How does that billion break down? Did they give any color on that?
They did, roughly. They estimate about $700 million of that is sort of lost opportunity revenue. Shippers finding other routes, maybe volumes just disappearing because the economics don't work anymore without that duty-free status.
Right.
The other $300 million, that's direct operational cost, more customs clearance work, new IT systems needed, more staff to handle packages that now need duties calculated and paid. It's a real structural cost increase they just have to absorb or overcome.
That number, that $1 billion drag, it just reframes the whole year, doesn't it? It's like they have to run incredibly fast just to stay in place against that headwind.
That's exactly it. It's a massive external counterweight to everything they're trying to do internally.
Okay, so let's shift gears then. From the Q1 results and these big macro drags, let's talk about the long-term strategy. The internal changes they can control. They're really leaning into cost discipline, right?
Absolutely. The core message internally is stick to the plan. That G-Drive program, they reaffirmed the target, $1 billion in permanent cost savings this fiscal year.
Okay, so $1 billion out from D-Drive.
Right. Facility consolidation, making the fleet more efficient. This is their controllable lever against that uncontrollable billion-dollar tariff hit.
And we're seeing proof points, like Network 2.0.
Yeah, they flagged progress there. Network 2.0, remember, is about merging the express and ground networks into one more flexible system. They said about 360 stations in the U.S. and Canada are now optimized under that plan.
Okay, 360 stations optimized. But how does that actually help them fight that billion-dollar friction? What's the operational benefit?
It feeds into what they call their tricolor strategy. It's basically about managing their assets, especially the expensive ones, much more dynamically.
Like their planes, the purple tail.
Exactly. They're being aggressive with those air assets. They specifically mentioned cutting Trans-Pacific Asia capacity, flying their own planes less on those routes by 25% year over year.
Wow, 25% is a big cut. That's deliberate.
Very deliberate and likely painful. But they're shifting that capacity, those planes, to lanes where they can make more money, like Asia to Europe. It shows they aren't just stuck with fixed costs. They're actively flexing the network to chase higher margin demand and reduce the burden of their most expensive infrastructure.
Okay, so proactive moves on cost and network. What about the really big structural change, the freight spinoff?
Still full steam ahead on that. They reaffirmed the plan. Spin off FedEx Freight, the LTL business, into its own publicly traded company. Ticker will be FDXS. Target date, June 2026.
And this is getting real, right? They hit some milestones.
Very real. 2 crucial milestones this quarter. First, they confidentially submitted the Form 10 to the SEC. That's the huge document you need for a spinoff. And maybe even more telling, they formally requested a tax ruling from the IRS on the separation. Getting those done suggests they are dead serious about hitting that June 2026 date, no matter what the economy is doing right now.
Interesting. And operationally for freight, they're building out a dedicated sales team for LTL.
Yeah, a goal is 400 specialists focused just on LTL sales. They said they've already got about 200 onboarded.
Why is that dedicated team so important before the spinoff?
Well, LTL is different from selling package delivery. It's more about relationships, specific service needs. If they want FDXS, the new company, to get a good valuation right out of the gate.
Which is the whole point of the spinoff.
Exactly. The theory is LTL companies often trade at higher multiples than these big integrated logistics firms. So they need FDXS to be showing strong, high-margin freight volume from day one. That dedicated sales force is laser-focused on getting that better mix of freight now, making the SpinCo more attractive to investors later.
Got it. Makes sense.
Okay.
Okay, now let's touch on something that sounds maybe more futuristic. This focus on monetizing their data.
Yeah, this is where things get really interesting, potentially game-changing, moving beyond just trucks and
The
boxes.
scale is incredible. 17 million packages a day.
Generating 2 petabytes of data, 100 billion transactions. Management is basically saying, look, we have this unique, unmatched view of how physical supply chains actually work.
logistics intelligence.
Exactly. Intelligence that they argued nobody else can replicate.
And it's not just about tracking where your package is anymore.
No, it's way beyond that. They hired a new chief digital and information officer, a CDIO. The mandate: speed up the use of AI across the company, sure, but also, and this is critical, explore new revenue models.
Okay, new revenue models based on data. What does that actually look like?
It could mean selling that logistics intelligence as a product. Imagine selling predictive insights on supply chain risks, or maybe an API that gives real-time disruption warnings, or even selling analysis on inventory movements to manufacturers or retailers.
So the value shifts from just the shipping fee
to the data around the shipment. They're building data moats. And this potentially is how they try to change their story, move from being valued like a traditional trucking company to maybe something closer to a logistics technology company. That implies a higher valuation multiple.
Fascinating potential shift.
Okay,
let's bring it back to the near term, the forward look. Management reinstated full-year guidance. That was seen as positive, right?
Definitely a positive signal. Reinstating guidance, the numbers they put out, 4% to 6% revenue growth for the full year.
Okay, and earnings.
Adjusted EPS in a range of $17.20 to $19.
That's a pretty wide range, a $1.80 difference between the low and high end.
It is, and that range reflects the big uncertainties they don't control. How global trade evolves this year, the health of that industrial LTL economy we talked about, and also how much traction they get in those higher margin B2B areas like healthcare, where they did see good growth in Q1. Basically, the guidance range maps how confident they are in navigating that huge $1 billion external friction from the tariff changes.
Okay, so let's connect the dots again. The big question the market must be asking is this.
Yeah.
If they hit, say, 5% revenue growth, right in the middle, and they deliver that promised $1 billion in D-Drive cost savings, why isn't the EPS forecast higher? Why doesn't it show more, flow through to the bottom line? It kind of feels like they're just treading water despite the effort.
That is the critical question. And management was surprisingly direct about it on the call.
What did they say?
They basically said the reason the flow-through looks muted is precisely because of that massive structural headwind. That quantified $1 billion annualized drag from the global trade and tariff changes. They essentially have to use the entire $1 billion, they say, from the Drive program just to cancel out the negative hit from trade policy.
Just get back to zero, basically.
Pretty much, before they can show any clean bottom line growth from higher volumes or better pricing.
So the story for this year, FY26, is really internal execution to derive savings is locked in a battle against external friction, those tariff impacts.
That's the near-term story, yes. Internal control versus external pressure. The medium-term story, the one they want investors to focus on, is all about successfully separating freight by June 2026 in a way that unlocks value.
Right.
And hoping, presumably, that these macro trade headwinds ease up a bit next year.
So they're saying bet on what we can control, the cost cuts, the network integration, the spin-off, because we're actively fighting the external stuff.
That's the narrative. And they backed it up by saying they completed $500 million in share buybacks in Q1.
Okay.
And they're sticking to their annual capital spending target of $4.5 billion. So investing in the transformation while also returning cash.
Understood. It really is a battle of operational grit against the macro tides. Okay, we've laid out the facts, the numbers, the strategy. Now it's time for our favorite part, exploring those let's call them aggressive but plausible trade ideas based purely on what we heard in the call.
And just to be crystal clear,
this is not financial advice.
Definitely not financial advice. But yeah, using the specific numbers and that strategic timeline they laid out, here's something to chew on.
Okay, lay it on us.
The core idea, the thesis is this. The market right now, the current stock price, is maybe baking in too much permanent damage from those global trade headwinds. That $1 billion tariff drag. Maybe the market thinks it's forever.
While at the same time,
it might be underpricing the stuff that feels almost guaranteed to happen. The structural improvements, we know the $1 billion in D-Drive savings is targeted for this year. We have a hard date, June 2026, for the freight spinoff. Those feel much more certain than predicting global trade flows.
Okay, so how do you play that? Bet on the certain structural stuff, overcoming the uncertain macro stuff.
The idea would be something like this. Consider buying out-of-the-money call options, but critically, with an expiration date after that anticipated June 2026 freight spinoff.
So maybe looking at July 2026 or even October 2026 options.
Exactly. It's a pure bet on management executing their strategy, and that execution eventually overwhelming the macro noise that's weighing on the stock today.
What's the catalyst you're betting on?
You're betting that the combination of two things drives a PE re-rating. meaning the market values the earnings higher. First, sustained cost-cutting from G-Drive showing up consistently. Second, the portfolio simplification from the spin-off. You'll end up with two cleaner companies, the Express Ground Network and the separate LTL Freight business, both potentially seen as higher margin, more focused entities.
And the bet is that this re-rating, this multiple expansion, will be powerful enough to swamp the drag from the FY26 trade issues.
That's the bet. You're essentially saying, I believe management will deliver on the structural promises, and that's worth more than the current macro headwinds suggest. It's a bet on execution over environment.
A compelling, if definitely bold, bet on the long-term structure versus the near-term cycle.
Precisely. It lines up with the timeline they've given.
Okay, great stuff. So let's wrap up our deep dive. Key takeaways. Q1 showed real strength domestically. Early signs of Network 2.0 paying off in efficiency.
Yep, a solid beat driven by the U.S.
But the entire narrative for this fiscal year, FY26, is shaped by this intense battle, executing that $1 billion D-Drive cost program directly against that unexpected external $1 billion tariff headwind.
It's a year of stabilization, maybe consolidation, not necessarily huge growth unless the global picture improves significantly. They're fighting to hold ground.
Right, and looking beyond just the packages and the fight against headwinds.
Yeah, that data angle is crucial. Management kept stressing their unmatched view of physical supply chain patterns. Those 2 petabytes of data, the new CDIO hire, the explicit mention of exploring new revenue models.
It leads to the final thought, doesn't it?
It does. Here's the provocative question to leave you with. Thinking about FedEx's future value, how much will depend on the physical act of moving the package versus how much will depend on selling the intelligence derived from moving billions of packages?
Are they becoming an information broker as much as a logistics provider?
It certainly feels like they're betting heavily on that transformation, moving from just LTL metrics to potentially AI and data monetization valuations.
A fascinating potential future. We will definitely keep an eye on how those digital revenue ideas develop. That's all we have time for in this deep dive. Thanks for joining us.